When days get hard, always remember that the sun is waiting to rise. I'm your host Muhammad Asif Jaja and you are watching my YouTube channel ETV 786. Through this channel, we are learning the basic concepts of accounting, and this is lesson number 16, Bad Debts and Provision for Doubtful Debts. Why provision for bad debts is required? Businesses that owe you money are your account receivables and have an obligation to pay you. However, it is not certain that they will pay for many reasons, from insolvency to cash flow problems. Payment may not be forthcoming. That's something that your business needs to account for on the balance sheet. That's why you create a provision for doubtful debts. Provision for bad debts. Provision for bad debts or provision for doubtful debts or the provision for losses on account receivable is the estimated percentage of total doubtful debt that needs to be written off during the next year. It is nothing but a loss to the company, which needs to be charged to the profit and loss account in the form of provision. It is done on the reason that the amount of loss is impossible to ascertain until it is proved bad. Classification of debts. Debts can be classified into three categories, which are as under. Number one, bad debts. It means the which are uncollectible or irrecoverable debts. Then number two, doubtful debts. It means which will be receivable or cannot be ascertainable, or the debts which are doubtful to realize at the date of preparing the financial statement. And number three, good debts. It means which are not bad, neither there is the possibility of bad debts nor any doubt about its realization, is known as good debts. Types of bad debts. There are two types of bad debts. Specific allowance refers to specific receivables that you know are facing financial problems and so may be unable to pay off the debt. Then the general allowance. General allowance refers to a general percentage of debts that may need to be written off based on past experience of your business. Provision for doubtful debt should be included on your company's balance sheet to give a complete overview of the financial state of your business. Where to show the provision for bad debts in the balance sheet? The provision for doubtful debt is an account receivable contra account, so it should always have a credit balance and is listed in the balance sheet directly below the account receivable line items. The two line items can be combined for reporting purposes to arrive at a net receivable figure. When you encounter an invoice that has no chance of being paid, you will need to eliminate it against the provision for doubtful debts. You can do this via a journal entry that debits the provision for bad debts and credits the account receivable account. How to calculate the provision for bad debts and doubtful debts? Typically, businesses estimate their amount of bad debts based on historical experience. When entering the provision for bad debts into general ledger, there will be two ledger accounts, the provision for doubtful debts and the provision for doubtful debt adjustment. Provision for bad debts example. To give you a clear picture of how provision of losses on account receivable works, here's an example. Imagine company A has a total of $100,000 account receivable at the end of the year. Company decided to create a provision for doubtful debts that will be 2% of the total receivable balance. So you can calculate the provision for bad debts as follows. 100,000 multiplied by 2% is equal to $2,000. Provision for bad debts example. However, by the end of the next year, company A total account receivable comes out to $150,000. This means that the provision for doubtful debts need to be increased. So this means that the provision for doubtful debts should be adjusted to $3,000, which is 150,000 multiplied by 2% is equal to 3,000. What will happen when company A's account receivable total has fallen to $125,000 by the end of the next year? This means that you need to adjust the provision for bad debts once again to $2,500, which is 125,000 multiplied by 2% is equal to $2,500. What is account receivable aging? Accounts receivable aging refers to a management technique used by accountants to evaluate the account receivable of a company and identify existing irregularities. Aging the accounts receivable sort the unpaid customers and credit memos by date ranges, such as due within 30 days, past due 31 to 60 days, and past due 61 to 90 days, etc. The aging report itemizes each invoice by date and number. Management uses the information to determine the financial health of the company and to see if the company is taking on more credit risk than it can handle. Accounts receivable aging reports. An aging report provides information about specific receivables based on the age of the invoices. It gives the management team a historical overview of the portfolio of company's receivables. It groups outstanding invoices based on the duration they have been due and unpaid. Usually, following are the categories of an aging report. Current, which is invoices which are due immediately. 1 to 30 days, invoices which are due within the next 30 days. 31 to 60 days, invoices which are 31st to 60 days past their due date. 61 to 90 days, invoices which are 61 to 90 days past their due date. Greater than 90 days, invoices more than 90 days past their due date. This is the portion of the invoices that could be considered as bad debts. How an aging report works. An aging report is used to show the outstanding customers' invoices and the number of days they have been outstanding. If the company's billing policy is to allow credit, the aging report allows the company to keep track of the customers' invoices and when they are due. The company's management should generate an aging report once a month so that they know the invoices that are coming due. They can then notify customers of invoices that are past their due date. Uses of aging report. Number 1, collection practices. One of the ways that management can use accounts receivable aging is to determine the effectiveness of the company's collection function. If the aging report shows a lot of older receivable, it means that the company's collection practices are weak. Some customers tend to not pay their invoices when they are due, and they may wait until the second and third invoice reminder to settle their outstanding balance. If some customers are taking too long to settle pending invoices, the company should review the collection practices so that it follows up on outstanding debts immediately when they fall due. Uses of aging report. Number 2, credit risk. The accounts receivable aging report can also indicate which customers are becoming a credit risk to the company. Older accounts receivable expose the company to insolvency due to the risk that the debtors may be unable to pay the invoice. If the report shows that some customers are slower payers than others, then the company may decide to review its billing policy or stop doing business with customers who are chronically late payers. Management may also compare its credit risk against industry standards in order to determine if it is taking too much credit risk or if the risk is within the normal allowed limit in the specific industry. Uses of aging report. Number 3, allowance for bad debts. Management may also use the aging report to estimate potential bad debts during the reporting period. They evaluate the percentage of an invoice dollar amount that becomes bad debt per period and then applies the percentage to the current period's aging reports. For example, assume that company XYZ allows for a 1% bad debts allowance for the 0 to 30 days period and a 3% bad debts allowance in the 31st to 60 days period. In the current period, the company reports $100,000 debt in the 0 to 30 days period and $50,000 debt in the 31st to 60 days period. This means that the allowance for bad debts is $2,500. Viewers, this channel is created for business and commerce students. It includes the playlist including complete lessons on basic concepts of accounting in sequence with multiple options. Right one may be chosen for study. Please try it. You are watching the YouTube channel ETV786. Please view, like and share the videos and subscribe the channel for watching the updated uploads. Bye bye.